Picture being able to lock in a tax deduction in a year that you really need it, but having time, potentially years or decades, to figure out which charities you want to support and allow them to benefit from your contribution. That's a function that a donor-advised fund can provide. Retirees might use this option to match unpredictable income years, where they're able to get a deduction and put money away, in addition to not having to rush and decide which charities they're going to give that money to later on. Let's say you experience a larger than normal income year, whether it's selling highly appreciated stock or even the sale of a business. Making a contribution to a donor-advised fund could allow you to capture that deduction immediately. It's important to note here that as far as tax rules are concerned, any money given to a donor-advised fund is irrevocable and cannot be taken back. At the same time, you do retain the ability to end up making the recommendation for where those funds should go. However, also important to note, the sponsoring organization of the donor-advised fund has the legal say in where the money ends up being contributed. Another potential advantage that I would take into consideration here is donating highly appreciated assets. Imagine purchasing a stock for $50,000 years ago, and it's now appreciated to a position of about $500,000. If you decide to sell it at this point, the entire $450,000 gain would be subject to tax. However, by transitioning that to something like a donor-advised fund, those capital gains end up being taken on in a tax-free manner when sold by the fund, and you are able to take the full deduction up front. It is worth noting, however, these deductions and contributions do come with limitations. Generally speaking, contributions made via cash are generally deductible on your adjusted gross income by up to 60%, but contributing long-term appreciated assets over time are deductible up to 30% of the value. Any unused deduction in the current year can be carried forward for up to 5 years, and this can be a meaningful impact on your overall planning if you think that you could have high income years going forward.